This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Hi, I'm Chris Judd and this is Talk Your Book, and today we're joined by Rob Tucker, from Chester Asset Management. Rob, first time on the show. Thanks very much for making the time.
No, thanks for having me.
Now, we'll get into Chester later on, but maybe dig in straight into the stock you want to speak about. And which stock did you want to discuss today?
Yeah, so we're going to talk about Synlait milk. So Synlait is dual listed in New Zealand and in Australia. Most of the volume is actually traded in New Zealand. But Synlait is best known for its relationship with A2 Milk, who are a 20% shareholder of Synlait. And they have done all the manufacturing for A2's infant formula to be sold around Australia, New Zealand and into China with the Chinese label product. So they are a dairy producer, secure the milk, turn it into infant formula or a base powder, and A2 is their major customer.
Is there a view that some of the New Zealand-based stocks sort of go under the radar a little bit, and particularly in times of duress offer some more value type propositions than their ASX-listed peers?
I think that's true because this tends to be, from our perspective, a very well-run company. John Penno was the founder. He built the company to where it was. He became a non-executive chairman last year and he's just removed himself from the board now. But I think the company's really well set up for future growth, and I'll explain why shortly. But this is a company that's trading below book value with really strong cash flow profile ahead of it. And
so talk to me, give us the helicopter view of Synlait and what they do.
So Synlait's been a frustrating investment for the last couple of years, and that's really because A2 effectively overproduced in the COVID period, up to 50,000 tonnes of infant formula, and then they realised China shut down, they didn't need to sell as much, so Synlait as their producer really effectively shut their factory for about 6 months. And so in 2021 they had a loss-making year, and the challenge with Synlait at that point was they'd spent $1.1 billion of capital providing 2 plants for these dairy products. So they're left with too much debt. So that's 2021. We've just finished the 2022 year where they've released a lot of the inventory that they'd built up. So their operating cash flow last year was very strong. And so the debt has become more normal in terms of net debt to EBITDA ratio. Still slightly high, but that will come down the next couple of years. So Synlait has been challenged through the A2 relationship, and I think there's a level of caution at the moment with Synlait because A2 at 20% shareholder, but they also bought a facility in the South Island of New Zealand called Natura Valley. So A2 is looking to offset some of Synlait's volume into their own facility in the South Island of New Zealand. So that seems to be one of the bear theses around Synlait as a cash generating company. We'd make a couple of points around that. The first being that they have a 5-year contract with A2 to sell infant formula into Australia and New Zealand and the Chinese label product into China. So the other bear point with Synlait at the moment is that the Chinese Food and Drug Administration, the SAMR, are reissuing their licence to sell Chinese labelled infant formula into China. So that is an area of perceived risk. But we'd note that so far SAMR has issued 22 foreign companies with their new licence to keep selling Chinese labelled infant formula into China. So we think there's actually quite a low risk of that licence not being reissued next year, but still it's a perceived overhang. So that's a couple of risks around A2 potentially moving their volume and the re-registration of their licence to sell infant formula into China.
And how significant was A2's move recently into the US market?
I think it's good from a sentiment perspective. The reality is it's not going to impact this year's numbers particularly, and we're still yet to see exactly how much formula they will sell into the US market. So I'd say it's great for sentiment, but we're not necessarily sure what that means for earnings just yet.
And how do you look at the relationship where A2 is shareholding in Synlait and then their major customer? Does that give you comfort that they're not going to reduce the equity value of that shareholding by doing something that would devalue Synlait's business, or how do you sort of view that relationship?
Well, it's an interesting one, so I'll get to it. So we've become quite positive on Synlait because A2 is about to be heavily diversified as their major customer. So 18 months ago, Synlait announced Customer S. Now, that it's a major global FMCG customer that they have yet to name for privacy reasons. The customer doesn't want to be named, but we'll find out in the next 3 or 4 months as physical product starts leaving the Synlait warehouse in New Zealand. But Synlait have repeatedly said that Customer S will be their biggest customer in 2 to 3 years' time. And so this is not necessarily an infant formula powder just yet. It's a plant-based food supplement from soybean extraction. Okay. So they're diversifying quite aggressively their reliance on A2 as their major customer. And this new customer, again, it was signed 18 months ago. They've spent probably $85 to $90 million refitting their factory in Pokeno to accommodate this new customer, and the cash flow will start being generated in the first quarter next year, but ramping up through 2023 with a full run rate in 2024. So that's what gives us the confidence that Synlait has actually got a really strong growth trajectory over the next 3 years.
And were those inventory level issues, do you think that was just a one-off given A2's experience throughout COVID, or do you think is that something you'll look to the future to make sure it's operating as well as you hope?
Yeah, well, there's sort of data points you can touch on when you're looking at sort of the inventory pull-through in terms of A2's market share in China and what's going on in Tmall or Taobao, some of those Chinese retail outlets, and the port at Littleton in terms of the data, the infant formula leaving the port. So there's some signposts you can look at to monitor how the inventories are tracking. But I think, so A2 was producing 50,000 tonnes, now it's going down to 34, 35, which we think will be stable at Synlait, because any future A2 growth probably goes through their Matura Valley property in the South Island. But if Synlait kept on producing that amount of infant formula for A2, we think that creates a really strong base for the growth with Customer S, we're going to call it, in the next 3 years.
And so maybe give us a bit of an overview of the numbers. You mentioned they're trading below book value, but what's their sort of free cash flow numbers, and what could you see for top line growth given the acquisition of a new major customer coming on board next year?
Yeah, so we're sort of quite confident given there's has been a lot of pessimism around Synlait and around the financial leverage largely, but Synlait is very confident with the new customer they'll generate a return on invested capital above 15% in 2025. So the invested capital is $1.1 billion. So really this is a story of actually having a really blue chip asset base, 2 of them, Dunsandel and Pokeno, that will generate an acceptable return with A2 as a customer and Customer S as a growing customer. So we think that equates to about $165 million in EBIT in 3 years' time. And the market is quite cynical on that, achieving them objective. So the market's about 130 million. So we still think if they can demonstrate to the market the new customer is being rolled out as they think, there's probably upside earnings over the next 3 years as the cash flows come. So that's an EBIT number, but simplistic, I'll give you an EBITDA number. Last year, the adjusted EBITDA was 117 million, 2022. The new customer starts in 23, but fully is operational in 2024. So we think the 117 becomes $180 million in EBITDA in FY24. Given they've spent the capital, they don't need to spend any more growth capital. It's just going to be maintenance capital. So that'll be $25 to $30 million a year. And notional amount of tax, because they had a loss-making year, which is probably $20 to $25 million in tax. So we can see a really strong scenario where the free cash flow after tax is between $100 and $120 million. And we're buying this as a $600 to $650 million company. So the free cash flow yield, we could say, is quite comfortably above 15% in 2024. So again, we think often on an asymmetric basis, in terms of the risk-reward profile, we thought the risk was minimised, even though they'd had too much debt on the balance sheet. But with the Customer S ramping up, we see really strong cash flow growth, and therefore that will be able to de-gear the balance sheet really quickly in the next couple of years.
And what's their debt levels gotten down to now?
So it's about 2.5 times net debt to EBITDA, and they think they can target around 2 to 2.3 in FY23, but that on our numbers would be well and truly below 2 times net debt to EBITDA in 2024 when they start paying dividends. So if you use the numbers I just gave you, $100 to $120 million in free cash flow after tax, we think they should be able to afford a dividend of $40 to $50 million back to shareholders, which again, the market cap today I think is about $750 million. So it suggests the yield could be well above 6%.
And is there any bolt-on acquisitions in cheese or other sort of products that you could see happening, or you think with where their balance sheet's at, they've sort of got to get that?
They've done a few of those in the past with mixed success, to be honest. So I think as far as we can see, it's really paying down debt, proving that Custom S is going to be ultimately their biggest customer in 2 years' time. And we know, well, we speculate it's an American FMCG customer that may have far broader use of the Synlait facility and not just this soybean protein-based food supplement. They may in fact need some infant formula space as well.
They had issues with infant formula in the US earlier this year, didn't they? But this sounds like it's not related to that. It's a different product line.
We are interested to watch how Synlait unfolds this new customer. We believe there is an aspect to providing broader product lines than just the soybean food supplement. We think there's a very strong chance there's an infant formula range to come as well.
Yeah, okay. That's very good, and we're always open to humble brags here at Chris Judd Invest. I understand Chester Asset Management won an award during the week. Can you walk us through what that meant? Maybe give us an overview of Chester Asset Management and how you guys look to invest as well. Yeah,
so we were fortunate enough to win the Money Magazine Best Australian Share Fund for 2023. And I guess we were obviously thrilled with the recognition. But it was based on 3 and 5 year numbers, but risk-adjusted numbers, so risk-adjusted returns. So we've been very focused on protecting capital in down markets. So that's sort of something we've been able to do successfully the last 3 years. So we are an Australian equity fund. It's 35 stocks to 40, but normally about 35. And it's a broad cap mandate, so we hold CSL in the large caps down to a couple of micro caps that we think can double over the next 3 years. So it is on average a mid-cap strategy. And so we separate the universe into 3 pretty distinct buckets. Most of it is predictable cash generators, CSL or the infrastructure names or consumer staples. We're very happy to hold some cyclicals, but it's normally 15 to 25% of the fund. And why we think a little bit differently than most investors, we've always had an allocation to gold, because I think gold can give you a non-correlated exposure when markets get inherently volatile. I'm not trying to predict the gold price or the direction, but I think normally gold equities act in a non-correlated manner, which is the reason for it's a little bit of a hedged position effectively. And hopefully we can pick the right gold stocks to give you that alpha when the rest of the market's a bit tricky.
Beautiful. We'll look forward to following along with Synlait. Hopefully, in an era where value stocks and hard asset stocks seem to be in vogue, looks like a great pick.
Thanks, Chris. We'll see how it goes.
Thanks for coming on.
Yeah, thank you.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.